Okay, fine. I'll start the webinar. Good day to one and all. This is Dr. Sivaraman of inoindices.com. I welcome you all for this Asian session live market analysis, which I am presenting on the 5th of May between 5 and 5:30 GMT. So I'll be giving the derived forecast for this particular week, 5 to 9 of May, and also explain how exactly the session-wise moves are going to happen in this particular week. Besides, the levels in which the currencies are expected to make the moves also I will give it to you. They're all mathematically and statistically derived information, and the actual market may differ. So in order to fine-tune these forecasts as well as the levels, so we do the market reading technique using the live market code page and also find out how exactly they set the initial lows and the highs around 3:30 GMT, and from there how they make the different types of market moves. So based on the type of market moves, we try to derive what could be the next move. Accordingly, we try to plan our trade. So that is how we use the forecast as a guiding factor, the levels as the mathematically derived information. And this is something like any other type of analysis wherein the element of error is bound to happen. So in order to fine tune it, we try to use the market reading. Besides, we also know that as long as we are human, we can commit mistakes even while making the market reading using the live market code page. In the event if our reading goes wrong, we cannot afford to lose money. So what we do is use the trading strategy to limit the risk and maximize the profit. So this is how my trading system works. So let me explain to you the algorithm-based derived forecast for this particular week. Now, before going to the forecast, let me explain to you what happened on Friday. Now, you know that last week we came across only the non-farm payroll release. Normally, what happens during this particular trend reversal week, we do come across, or the first week of any month, we come across the BOE and ECB interest rate decision, ECB press conference, and also the non-farm payroll. And sometimes you come across BOE interest rate decision being shifted to the next week, like the last month, the month of April. But this time, what has happened? Only the non-farm payroll was released during this particular week, last week, and then the interest rate decisions with regard to BOE and ECB are being included in this particular week, besides the ECB press conference. So whenever you come across the prime data are being shifted to 2 weeks, they invariably extend the trend reversal moves for 2 weeks. So what the extended trend reversal? They just do it for the last week. They had done it for the last week as the month end trend reversal move, followed by that of the month beginning trend reversal. And normally what they do is they set the trend during that of the non-farm payroll release, and then subsequently you come across a week beginning false move, followed by that the trending move in the market. But this time, since you come across the other two prime data are to be released only in this week, they just quickly made the drop for a phenomenally good non-farm payroll, and then subsequently they could not hold low because they need to gain the levels and again confuse the traders and also build the sell positions in this week before the drop for that of the ECB and BOE interest rate decisions and the ECB press conference. So in that process, what they have done it, they quickly gained the level by using an excuse that Ukraine crisis. So some excuse they try to do it. And you know that last year when US data, the non-farm payroll was decimally poor. And you know that last year when the data was less than expected, the non-farm payroll was less than expected, then immediately they just made a small gain in the case of Euro and GBP and started dropping Euro and GBP in the name of the risk aversion. In the name of risk aversion. So when the non-farm payroll was less than expected, then the people expect Euro and GBP to go up. But the players dropped Euro and GBP at that time, and the excuse was the risk aversion. At this time, the non-farm payroll was phenomenally high, and the data was so positive. And so everybody expected Euro and GBP to drop. And they gained the levels in the case of Euro and GBP, and they could not use the word risk appetite. Because fundamentally, US dollar is supposed to become strong based on the data. So instead of using the risk appetite, they started using the word Ukraine crisis. So you come across the Ukraine crisis even whole of last month many times. And whenever they want, they use it as an excuse, and other occasions, they talk about the European economy or US economy and things like that, and then subsequently try to make the moves in the market. But ultimately, the hidden agenda is they wanted to hold the levels and also continue to make upward stop-ins and build sell positions before making a big drop in the market. So that is what they have planned. So that is why I made a posting in that of the fxtrade.net, and when the traders derive from that of the outcome of non-farm payroll, the players, and develop the sentiment and commit positions, the players acted against them. So this people need to understand. Hence, when such surprise moves happen in the market, we should be in a position to protect our equity. We could not simply say that, no, my derivation was correct, but the market has gone against crazy market. And I can use any sort of words to talk about the market, but that is not important. How exactly I have protected my equity is important. And for that, we need to use the hedging order to limit the risk. In the event if we are sold after the drop, use the hedging order to limit the risk so that when they go against us and the hedging will be making profit, we can book profit in the hedging and then keep another hedge order above that. And when they start sliding, we'll continue to trade. So this sort of trading strategy help us during this sort of vital occasions. Now coming to that of the forecast. Now, here you come across the first week because only first and second well been seen in the last week. So this happens to be the first week. In this, you come across the volatile moves because of the data release of BOE and ECB, and you'll come across slowly the downward bias in this. And from that of next week, we'll come across visible downward trending move in the market. So what are the expected market moves for the three different sessions of this week? So there are three sessions in a week, in a day, Japanese, European, and US session. The session timings are also given here. In between that session is a gap time during which they make the false move. And you can just watch this particular move. Okay, swing and slide. Okay, when they are near the high, take a sell and book profit during the slide. Then swing and firm up when they are near the low and not cut the low for 30 minutes from the start of the session, 7:30 to 8. Then take a buy and book profit during firming up move. And again, you can take a sell and try to book profit during that of the slide. This sort of swing trades, you can do it. And for that, I am giving this. And still, you use the market reading to fine tune the trades and also use the hedging order to limit the risk. So the expected market moves in these 5 days of the week, swing and slide during that of the Japanese session, swing and firm up during European session, and again swing and slide is expected during that of the US session of today. And tomorrow, they're expected to make a dip and then for the slide, then swing and rise, and then swing and slide. So here you'll come across during the European session, they will invariably try to make upward stop-ins. And during that of the US session, they will try to make the downward stop and a small slide during the Japanese session. That is how they are expected to make the moves. On 8th, you'll come across the BO and ECB, and the swing and slide moves are expected during Japanese session, and they are expected to make the swing and firm up move during that of the data release time, and then subsequently swing and slide during that of the US session. And then they are expected to make a drop and then swing and firm up and drop, then swing and slide. Then you will find, okay, the players have respected non-farm payroll data and started making the USD gaining move. So that is what we'll come across at the end of the week. Then followed by that, we'll come across a little bit of volatile move, but the downward trending move will start becoming visible. And this downward trending move is expected to happen till end of June. Now, with regard to the expected market levels, and the actual lows and the highs of today, or so far what they have shown, is given here. Above that, the derived levels are given, mathematically derived levels. So euro could go up to that of 1.3925 during that of the stop point, and then they will come down. Then similarly, in the case of GBP also, they could gain it to 6925 during that of the data release time, and then subsequently come down. And in the case of yen, they have already done the downward stop and move, and they are expected to gain slowly the levels. And CHF also, they could go to that of 87.50, then start gaining the levels. So swing and rise moves could be seen. In Canadian dollar, they are expected to make a move downward to that of 1.0850 level, and the high could be 1.100. And they are expected to consolidate here, quickly make a downward move. And people might think that, okay, 1.0850, we should quickly grab, otherwise they may come to 1.09 level, but they will simply hold it for a day and test the patience of the long holders and induce them to liquidate the long position. Even though euro and GBP are expected to show USD gaining move, and Canadian dollar, similar to that of USD yen, is expected to make the USD weakening move. You know that when euro and GBP are showing the USD gaining move, you find that USD yen many times show the USD weakening move. Similar to that, they are expected to make this time. When euro and GBP were making the USD gaining move, USD CAD by making a downward move show USD weakening move. And Australian dollar is also expected to make a swing and slide moves, and that will be making the USD gaining move on the downside. So when Canadian dollar and Australian dollar, USD CAD and Australian dollar start making the downward move, it will be a typical contrarian move among that of the commodity pairs in order to handle the commodity crosses. So these are all the levels expected. Now coming to that of the market reading. Now the initial lows and the highs are noted down around 3:30 GMT. And now we'll try to compare it with the market. So euro formed the 1.3865, but actually what is shown here is wrong. 1.3812, it did not go down that much. And that was actually Friday low. And 1.3876, 1.3885 is the high. They are not breached the low of the high. And in the case of GBP, 1.6870. They are shown the new low. They cut the low by 1 pip. And 1.6885 is the high. They are not breached it. And in the case of yen, 101.87, they made the downward move, started gaining the levels. And 102.26 is not breached. So they are expected to slowly show the USD gaining move. And in the case of USD CHF, 87.68 is the low, 87.82 is the high. They are not breached the low or the high. So in the case of euro and USD CHF, they are not breached the low or the high. But only in the case of GBP, they just breached the low by 2 pips. 1 pip. Let us see how exactly they are going to make the moves. Then in the case of Canadian dollar, 1.0969 is the low, 1.0984 is the high. They are not breached the low or the high. But you can see that both Canadian dollar as well as Australian dollar showing the negative net change as explained. Then 90 to 53 is the low, 90 to 90 is the high in the case of Australian dollar, and they are also not breached. So you come across only in the case of GBP, they made one quick downward move below that of the initial low for 1 pip, and then started gaining the levels. Let us see whether it is a stop end or it is an extended more intentional move by watching it for another 30 minutes. So what do you do with regard to the trading part of it? So we watch the market up to 3:30 GMT in 4 majors and 2 commodity pairs using the live market code page and try to see whether the market is near that of the high or near that of the low. When the currency is near that of the high, not breach the high for 30 minutes, we'll try to take a sell. And if it is near that of the low and not breach the low for more than 30 minutes, we'll try to take a buy. And then keep 30 pips hedge order to limit the risk. And once the position makes profit, we try to keep stop at entry, about 15 to 25 pips profit is seen. We keep that stop at entry and remove the hedge order. So there we use the hedge order as a risk limiting factor and not for either way trades. Then subsequently, once the market moves in our favor, we'll trail the hedge order and also keep a limit of 45 pips or 75 pips. And 45 if the momentum is very less like now. And if they continue to breach the low or the high, then we will increase it to 75 pips and use the trailing stop to get the minimum profit and use the trailing limit order to maximize the profit. That way we'll try to earn money from that of the market, and we avoid taking any sort of risk or speculation in the market, even though we do all sorts of analysis and give the forecast, but still in trading, we should not miss the situation. That's the most important thing. Our human brain, the decision-making ability will be lagging slightly when compared to that of the market moves. So when suddenly the market makes a downward move, we will just wait for another 2-3 minutes to find out or ascertain whether it is a stop end or an error, and then probably it might go up and things like that. So invariably, we will wait for a confirmation. But the market, once it makes a downward move and quickly another downward move, which is going to take away your usable margin if you are not used the stop. And if you use the stop, then your position would have been closed. So that is why many traders avoid keeping the stop, including the institutions. So what is the next opportunity? The next possibility is the drawdown can increase to a greater extent. And if the drawdown goes beyond 15%, then probably they might be forced to close the positions. So you find just because the drawdown is there and we can still open the position or keep the position, and without any hedge order, if you think, then we might be put into danger. So that means we are taking an unlimited risk. So you should be able to take a decision on your own whether we can afford to take such unlimited risk, or we billionaires to take such unlimited risk. We have to see. Otherwise, keep the stop or the hedge order to limit. As a compromise, if you use the hedge, then if the position is hedged, our money is blocked equivalent to that of the loss. But we have the positions to recover the money. But if you use the stop closes the original position. We have to think of entering into the market with a fresh position. And there comes the difficulty as human, that once we have incurred a loss, we hesitate entering into the market. Whereas if we use the hedge order, the position might be hedged. So there is no need of hesitation. And only thing is we have to review the market in relation to that of the original position and that of the hedge, and see which position you can close and maximize the profit with the other position. So that sort of decisions you can take leisurely if you use the hedge. Now they are making the contrarian moves in the market. So in order to do all sorts of market reading, or identifying the type of moves, we need to know the market timings followed by the players. So 0030 to 7 GMT is the Japanese session, and 7 to 7:30 is the gap time between the session, and during which they make the false move. And during the early and the late sessions, they handle the majors, and during the mid sessions, they handle the crosses. And 7:30 to 13 is the European session. 13 to 13:30 is the gap time before the start of the US session. And 13:30 to 20:30 is the US session. So which is again subdivided into early, mid, and late sessions. So the early and the late sessions are 1.5 hours from the start of the session and 1.5 hours towards close of the session. And in between is the mid session. During the mid sessions, they handle the crosses. And during the early and the late sessions, they handle the majors. If you use the live market code page and try to watch it following these timings, you'll be able to really understand this is the timing the players use it. And they don't use the timings, what we conventionally call it as an Asian session, European session, UK session, New York session, US session, all those things. They are mainly given to that of the traders in order to get confused or try to bring the market to the local timing. That is why you come across that market is being brought into that of the local time, the Eastern Standard Time. They have brought it, but actually you are supposed to follow it using the GMT time frame in order to understand the 24 hours market cycle. So various organizations, knowingly or unknowingly, they try to misguide the traders. But as traders, we need to find out why we have been taught like that. And we are taught like that, we follow it, but still we are not able to earn. Then we have to use our reasoning ability to find out, are we misguided by such organizations? If that is the case, then we can just read it, but there is no need to follow it, no need to trust it. So this sort of decision has to be taken by that of the traders. And the decision-making ability is ours. Nobody can control it and nobody can stop it. And so just because the players use the media and use various other communication channels to give it free of cost, all the forecast or the sentiments, market creating sentimental news, etc., all excuses, the reason for the market downward move, reason for the market upward move, they can call it as a specific reason and give it. But later on, you find the market makes a different move and they try to give various excuses using various experts and analysts. So we should be in a position to discriminate all. And only then we'll become a successful trader. A professional is a one who listens to all, but he will not use it for his market reading or understanding. He will try to find out whichever is working for him. So I'll come back during Thursday to review the forecast. That is 8th of May. Before that, I'll try to answer to the other questions. Okay, George. Euro and GBP going up. Okay, that is how they create the sentiments. So, okay, Friday they quickly made the gain, right? Why not they continue to gain the levels? Ukraine problem. Why not they use the same word or same phrase and try to gain subsequent levels? Gaining the levels is not important for the players, as explained many times. If the traders commit sell positions following the fundamentals, and after the drop, if they become late entrant and try to take sell positions, the players quickly gained the levels and use them to do the short covering. It's a money-making process. Okay, after gaining it, they can easily gain 100 pips today, telling so many problems, but they have not done it because that is not their objective. So please understand, just because for non-farm payroll they dropped and gain, doesn't mean that every day they have to do the same. And the same trick will not work every day, you know very well. You can be tricked only once. Later on, you become cautious. what they do is the traders avoid taking positions. The traders wait for the next data release and then try to commit positions. So the players also try to give profit to them. Only then the traders will be participating. Every time if they try to make the market move as a surprise, then nobody will enter into the market and they will simply say it is gambling. So next time what they will do, they will follow a fundamental and try to make the move in tandem with that other fundamental. They will follow the technical oversold, bought condition and try to make the move in relation to that other technical, so that people will think that, okay, that was an exception. Non-farm payroll was an exception. Otherwise, the market is following the technicals and fundamentals. Then later on, they commit more positions. Once more positions are committed, then the players create the market sentiments and act against it of the traders to grab as much money as possible. So it is a typical gambling den tendency. As soon as you go into that of Las Vegas gambling den, you are given $5, $10 profit in any of the gamble you enter in. Then you become more interested and try to commit more position or money. And later on, see that all the money is lost. And when you are just standing there and watching one game, you might see another man sitting next to that another game and trying to accumulate the money like anything. And that will also give you a trigger. When that man is capable of earning it, I am smarter than him, I look smarter than him. So why not I bet more money so that I will also earn? So that is how they try to induce our gambling tendency. So for that, they try to pretend as if the market is following technicals and fundamentals from time to time. Okay, Joe. What about gold? Gold, they gained the levels and they are expected again make the volatile moves in the case of gold. They could come down to 1280, 1285 and again go to 1325 range. And if they start gaining the level immediately, if you think that it will go to infinity, that is your mistake. Well, Eric, Euro and GBP have clear tendency to end low this week. See, they are all currencies. Okay, they don't have life. They are all currencies. And what you come across here, nothing but the ratios. Fourth decimal ratios, and you will not be able to physically take 1.3874 euro. They are all nothing but the positions. Whatever the positions you take, and that has to be liquidated in the market. Okay, so discriminate from that of the physical currency to that of the market. In the market, you come across the leverage trading. Either it could be 1:50 or 1:100. So you commit more, even though you try to take one lot, and you might be having about 100K positions. So you have to understand how much of risk you are taking, depending in relation to that of the equity. So when they are doing the market moves in a leverage condition, if lesser the leverage, lesser the risk. More the leverage, more the risk when the market goes against. So we need to understand in this leveraged market, how exactly the players are going to make the moves. So even if you don't believe that there are players, understand that how the herd of traders are going to behave. And that is going to decide whether the market is going to come down or go up. Whether the traders have got, plenty of traders have got the urgency to accumulate more and more of euro positions. And taking more euro positions is not on delivery basis. Keep it in mind. The institutions, some of the institutions and the banks, they're going for a currency conversion. And hardly the currency conversion volume is only 1% of the total $4 trillion transactions. So don't think that anybody is going to take a delivery of these currencies in a huge quantity, even though we have been misguided that way. So when only 1% is the currency conversion, the rest of the things are all speculative, and they are all positions taken and entry and exit done by various institutions. And you need to understand how the players are going to make the moves in the market. So the players are expected to, as I explained, that they are expected to pretend till Friday, Monday, Wednesday, as if Euro and GBP could go up, and later on they are expected to make the drop. And weekend we will come across the visible drop in the case of Euro and GBP. And USDN will end high by end of this week. Yes, it is expected to go to further higher level to 103, 104 level. Which session is more volatile? There is no specific condition as a specific session is more volatile, etc. And if you watch carefully, on certain days you will find Japanese session is very dull. On certain days, European session might be very dull. On certain other days, US session might look very dull. It all depends upon the trader's participation. If there is a data release, for example, non-farm payroll around 12:30 GMT, then that will be the late European session. So during that of the Japanese session, the market might be very, very dull. Then during that of the data release time, it might be active. And like FOMC, that is by 18 GMT and the late US session, then Japanese and the European session might be dull. And there are certain data from Australia and also Japan. The data might be giving a trigger to that of the market, and the Japanese session might be active. So there is no hard and fast rule that the market has to be volatile only during European and US sessions. And the players try to do it in such a way that all the three sessions gain importance. So they will never let loose a session permanently. And an experienced trader will be able to say that. And if you just see it only for a few months, then you might be with the impression that the Japanese session is no good for trading and only European and US sessions are good because there is a little bit of volatility. And our main contention is once they make the spread between the high and the low is more than 40 pips, then the currencies become tradable. That means the players are going to make active moves in the market. So keep it that way. Then whenever the spread is not there, you wait for the spread to come and then commit positions. You'll be able to quickly close the position. Otherwise, if you commit a position and the volatility is not there and you hold it to that of the next session, then you lose patience because you have in between the other work, you may not be able to follow the other work or concentrate on that, and the market will be attracting you from time to time to watch whether any good move is happening in the market. So instead, you know that whenever there is going to be a data release time, you look into that of the Forex calendar and find out when the data is going to be released and set it in GMT time frame and try to find out in which session it is going to happen. And accordingly, before the data, you try to come into the market, you would have noticed the spread has already become more than 40 pips between the low and the high, and they will make a false move before that of the data release. And on Friday also, they just gained quickly the levels in the case of Euro and GBP. And then after that of 12:30 GMT data release, immediately they quickly made the downward move about 50 to 60 pips. Then stop cutting the new low for 30 minutes. Then you need to understand that they are going to reverse. That is what I was telling everybody. They stop cutting the new low. It is only an extended move on the downside for 2 hours. So they will try to make an intentional move on the upside later on. So that is how we should be able to find out what could be the next move by yourself. So you don't require any expert to say that. Once you learn their technique, no, it is nothing but you become cautious with such people. You know that in any of these subways and things like that, you come across the pickpocketers. And you know the tricks of the pickpocketers. And you read it in the magazines or also you hear it from others, how they lost their purse, etc. And you try to avoid cheating. The same way you try to do that. And read their intentions. And if the pickpocketer come closer to that, keep away. At the same time, tell them that I'm aware of. So that way you can straight away get rid of such situations rather than becoming surprised and just yelling at the market and shouting at the market. That does not help anybody. Then Shaukyat, is Aussie coming down? Yes, Aussie is expected to come down. Okay. USD INR, yeah, USD INR, as I explained, that INR is going to slowly become stronger and stronger, and all the regional currencies are expected to become stronger in the course of this particular year. They undergone the multi-year trend reversals. So you will not come across such high levels like $1 is equal to 68 rupees, etc., or the South African rand extreme levels. They had done it as a multi-year trend reversals. Yes, New Zealand dollar is also expected to come down along with the Australian dollar, but there will be slight volatility variations because you know that they have to handle Aussie New Zealand dollar cross. So now Aussie is 10 pips negative net change. New Zealand dollar is also equally 10 pips negative net change. But sometimes you'll come across Aussie in negative net change and New Zealand dollar is in positive net change. And that sort of contrarian moves, they do it mainly to handle the respective crosses. So ultimately, the majors are expected to weaken against that of the US dollar. And before that, the players are building the sell positions in the majors. So later on, after the drop, we will be able to realize it. And in trading, we should be able to foresee what is going to happen. Only then we become a successful trader. So I take this opportunity to thank FX Trade for the facilities provided, and also you people who have come here to listen to my webinar. And I'll come back on 8th of May, Thursday, and try to review the forecast what I have given and try to find out whether the market has moved in tandem with our expectations or against. So wish you all happy trading. Besides the forecast, use that of the market reading as well as the trading strategy to limit the risk and maximize the profit. Wish you all the best. Thank you.